Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Lucid stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Lucid is an electric vehicle manufacturer. It is also involved in energy storage. Its main focus for its first 7 years was battery technology, but then it began to develop its first car in 2014. The company is led by ex-Tesla engineering executive and automotive veteran Peter Rawlinson. In December 2019, Lucid broke ground on a factory in Casa Grande, Arizona, the first greenfield facility for EV manufacturing in the US. Its plan is to manufacture up to 400,000 cars per year. The $700 million facility is currently producing and delivering cars. The first car was delivered a few weeks ago on October 30th. Lucid's market cap passed Ford's before Lucid ever sold a single car. Let that sink in. Ford tried to acquire Lucid a few years back. After that merger fell through, Lucid was on the brink of bankruptcy, but received a huge cash injection from the largest wealth fund in Saudi Arabia. This investment helped the company get its Air EV ready for production. The cost of the Lucid Air starts at $77,000 and can go up to 520 miles on a single charge. This car won the 2022 MotorTrend Car of the Year. Its other cars are the Air Pure, the Air Touring, the Air Grand Touring, and the Air Dream. The cost for the Air Pure starts at $77,000, the Air Touring starts at $95,000, the Air Grand Touring starts at $139,000, and the Air Dream starts at $169,000. As you can see, the price tags are pretty hefty. Lucid plans to deliver 520 customer-configured Lucid Air Dream Editions, followed by deliveries of Lucid Air Grand Touring versions. Touring and Pure models are anticipated for delivery next year. Lucid was funded by a SPAC, a special purpose acquisition company is formed to raise money through an IPO, then acquire a private business to help them go public. This is also known as a reverse merger or reverse takeover. In the beginning of this year, the merger was completed and Lucid received $4.4 billion in cash proceeds. The SPAC that acquired Lucid was Churchill Capital Corp. 4. The company is headquartered in Newark, California, and was founded in 2007. It trades on the Nasdaq and Deutsche Börse. Let's get started with the model. This is a large cap company, 91 billion market cap. They're trading at $55 a share, and they have 1.7 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. We have their financial info for the first 9 months of 2020 and the first 9 months of 2021. And of course they have negative free cash flow because they haven't sold any cars as of these financials. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's negative as well. Revenue is the sales for the company, and that was $300,000 in the first 9 months of 2020, up to $700,000. This is the company's income statement. The top line is the revenue, the sales. According to their 10Q, revenue is from the sale of battery pack systems, supplies, and related services for vehicles to a single customer. It appears all their sales are to one customer. Since they sold their first car a few weeks ago, there's no revenue from car sales in these numbers. They're expecting to sell 20,000 cars next year, 49,000 after that, then 90,000, 135,000, and 251,000. And they expect their revenue to be $2.2 billion next year, then $5.5 billion, $10 billion, $14 billion, and $23 billion. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, which was negative in both years. Below that is research and development, which was $600 million in the first 9 months of 2021. Their R&D costs are mainly for their battery and powertrain technology, the Lucid Air, Project Gravity, and future generations of its EVs. And the costs for R&D are materials, supplies, payroll for the employees. Below R&D is SG&A, and that was $455 million in 2021, much higher than 2020. SG&A includes marketing expenses, as well as payroll for support functions. Examples are the admin staff, legal, accounting, and IT. This includes their salary, bonuses, as well as stock-based compensation. And this bucket also includes rent and depreciation. So their operating expenses were over $1 billion in the first 9 months. So they had a big loss in both years. And there's a lot of negatives in other income and expenses. There's negative $450 million in forward contracts. This is similar to an option. It gives the holder of the contract the right to purchase preferred equity from the company. And the reason there's such big negatives is because the stock price is going up so much. So the value of these contracts are so high, which is negative for the company. But these are all non-cash items. You'll see in the statement of cash flows, we're going to add back $454 million. The bottom line of the income statement is their net loss, and that was negative $408 million. Now it's negative $1.5 billion. This is the cash flow from operations section from their statement of cash flows. There's 3 sections in the statement of cash flows: cash flow from operations, cash flow from investing, and cash flow from financing. This is the first section. And the way you calculate CFO, you start with net loss, negative $1.5 billion. Then you have to add back the non-cash items on the income statement. Remember that $450 million forward contract? If the holder of that contract converts to stock, then the company doesn't have to pay them any cash. The person receives stock, although it does dilute you to current shareholders. Also, the company pays its employees with stock-based compensation. That was $366 million. That's not cash coming out of the company's pocket, so they have to add that back on the statement of cash flows. The employee's salary is cash, and the salary is an expense on the income statement. So it's part of your expenses, so it's baked into your net income number, which is up here, or net loss. Then you have depreciation and amortization, and a bunch of other things. You also have to adjust for changes in working capital. The company spent $60 million on inventory, so that's a cash outflow of $60 million. And it looks like in the past they bought something on credit using accounts payable, and they paid for it this period. So they paid $14 million on that stuff they bought. Even though they reported a loss of $1.5 billion, they actually only lost $745 million of cash flow. In the cash flow from investing section, pretty much all of it is in CapEx, property, plant, and equipment. They spent $356 million last year and $299 million this year. That could have been the cost for their factory. It could have been the cost for some equipment. And this is their cash flow from financing section. This is how the business is financed, whether through debt or equity. They paid $17 million on short-term debt. They paid $2 million on lease liability. They received $42 million on short-term debt. Preferred stock is a hybrid between debt and equity. It's similar to debt because you get a guaranteed dividend payment. It's also similar to equity because it can appreciate. It looks like a holder of the Series B preferred stock turned in their stock and got $3 million. And they issued $600 million of Series E preferred stock. A benefit of a company's stock price increasing is that the preferred equity converts from debt to equity. So it removes debt from the company's balance sheet, so it's less debt for the company to pay off. And this line, proceeds from the reverse recapitalization, that's from the SPAC that acquired this company. When a SPAC acquires a company, it's the same thing as a reverse merger or reverse takeover. When you hear reverse merger or reverse takeover, all that means is that a public company is acquiring a private company. So they had a cash inflow of $5.2 billion from their financing section. This money will really help the company scale and grow their business. This is the equity section on their balance sheet. They have $4.8 billion of equity. They raised $9.9 billion from selling their business. Additional paid-in capital is all the funds they've raised, not just from this IPO, but in the past as well. And they've lost $5 billion from running their business. Accumulated deficit is a sum of all your prior net incomes. Let's look at the capital structure. They have $4.8 billion of equity, $200 million of debt. They're 96% equity, 4% debt. And they have a big negative for net debt because they have so much cash on their balance sheet. And I gave them the highest whack on Finbox, 7.8%. And that's a discount rate we're going to apply to the future cash flows. We estimated 6 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 6, that's $88 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $54 billion. We divide that by 1.7 billion shares. And we get a calculated stock price of $33. They're trading at $55, so they're trading at a 70% premium. It's a sell according to the model. In the company's presentation, they gave us their forecasted free cash flows. And that's what I used for 2022, 23, 24, 25, and 26. And for 2027, I tripled their 2026, which I think is pretty aggressive. But even with tripling it, I'm still coming out with a stock price a lot lower than they're trading at. Of course, nobody can predict the future, even this company. They could do much better or much worse than their estimates. The stock price is based off a supply and demand of the market. If more investors feel the stock will go up, then they'll push the price higher. If more investors feel the stock will go down, they'll push the price lower. Some people think the stock will go up because they think it's the next Tesla. Some people are buying the stock and pushing the price higher because they think this is the next Tesla and this is going to be $1 trillion company. Other people don't really care how the company does. They just think other people will push the price higher, and they're buying the stock hoping to resell it at a higher price in the future. And there's nothing wrong with playing the markets. You may win, you may lose. Analysts seem really bullish on this stock, projecting their earnings to grow 52%, their revenue to grow 125%. They have below 1 million of revenue at this point, so 125% increase is not much. 3 analysts priced this stock and the average price target was $44. The low was $16, the high was $60. That's a pretty big spread. When a SPAC starts trading, it's always $10. And when that company announces an acquisition target, the stock price usually goes up, even before they acquire the company. And you can see the stock price got really high, well over $60. Then there's usually a big sell-off, people taking in their gains, and the stock price goes down. But in this case, the stock price is coming back up. And based off of market momentum, I think it's going to get past this point, probably above $100 pretty soon. The stock is up 385% since it started trading as a SPAC, while the S&P is up 32%. The 52-week low was 10, the high was 65, and the stock is trading well above its 50-day and 200-day moving average. And this is a very popular stock. Over 120 million shares have been traded on average each day the past 10 days. 69% are held by institutions and over 3% of the shares are shorted. And it looks like the employee count has gone up in the past 6 months. It's at 2,400. If you put $10,000 into this company when it was a SPAC, you'd have $17,000 today. The biggest shareholder is the Public Investment Fund of the Kingdom of Saudi Arabia. They originally invested $1 billion for 80% of the company. They've been diluted down a little bit, so they are 62%, but their value is $56 billion. That's a pretty good return on investment. The second biggest shareholder is Michael Klein, then Vanguard, Franklin Resources, and Blackstone. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They have almost no sales, so their price to sales is through the roof. Their price to book isn't so great at 18.8, even though they have so much cash on their balance sheet. They have a really high current ratio and quick ratio, and they have a ton of cash on their balance sheet, $4.8 billion, and everything else looks like a rounding error compared to that. Even though they lost $1 billion in the first 9 months of 2021, they still have a ton of cash on their balance sheet. They have $4.7 billion of working capital. Working capital is current assets minus current liabilities. So they have $3.7 billion of funding. But I expect the company to raise more capital and take on a lot more debt just to fund their businesses because it's going to be really, really expensive. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 16 companies in the same industry as Lucid. We can't look at their PE since it's negative. They have a terrible price to sales and price to book, a really high current ratio, a terrible ROE, they're really low in debt, and it's just amazing their market cap is bigger than average. And the average is high because of Tesla, and they're still above average. To summarize, I have them trading at a 70% premium. So the stock is way overvalued since they haven't sold the car yet, at least as of these financials. But their cars are amazing. They're beautiful. They go faster and further than almost all the EVs. They're the only electric vehicle that's actually nicer than Tesla. I think the cars are overpriced. And although there's a market, I think it's pretty small. The market for Tesla is huge because Tesla cars are affordable. I rank their free cash flows, revenue, and ratios 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom evaluation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.